This week on 9th August, we have 3 impactful webinars. By 10 a.m., we have 2 webinars. Master Wealth Milestone, how to turn financial goals into reality, and refunding risk for the Indian HNA, beyond traditional portfolios. Following by 11 a.m., we have NRI Insurance Blueprint, cross-border protection for global Indians. Link given in description. Click the link and join our webinars.
Welcome to the August 2025 Fixed Income Outlook. Now, markets are already showing some level of weakness and there is some profit booking that investors are doing. But the big question on their mind is, where do I put this money that I've booked profits from? If you're an investor with a legacy portfolio, then you should check out our last video where we had a conversation on what you should do on legacy portfolios. But for an asset allocator, it's time to really look at fixed income seriously. And we're going to give you 3 updates this month that should make you consider your fixed income allocation. The first thing that we're going to touch upon is the Fed policy. Now, this was announced towards the end of July, and it gives us some insight into what the US economy is grappling with. The most important thing of concern is the fact that the US economy has slowed down significantly between 2024 and 2025. If we look at half-year data projections, in 2024, the US economy grew at 2.5%, whereas this year the growth has only been at 1.2%. When we dig deeper and try to understand where this slowdown is coming from, one, of course, is the tariff policy, which has caused a lot of variation in growth in 2025. The next thing that you want to look at is the labor market. While the data shows that unemployment levels are at 4.1%, which is a comfortable figure for the Fed, what's worrisome is that consumer spending has actually slowed down. Now, if consumer sentiment is weak, the US economy isn't growing as much, it's only a matter of time before these sentiments reflect in actual numbers. Now, the Fed actually has to be preemptive in its rate cuts. It can't wait for an event and then respond to it, because typically monetary policy already acts with a lag. So cutting interest rates later or waiting for something to occur before you make that rate decision could actually result in a higher risk scenario or require a lot more policy support. So the case for the Fed to cut rates is actually sooner rather than later. The second data point that we're going to study is the India yield curve. Now, for a fixed income investor, obviously returns from fixed deposits have already started declining, but there is a tendency to be safe in this space. So where can an investor choose safety and also get the best risk-adjusted returns? Now, the government yield curve is a great place for you to start, because if we look at what happened in July, yields actually widened but not evenly across the curve. This creates entry opportunities in certain categories of bonds. So when we look at the government yield curve, your 1 year or your shorter maturities have almost fully repriced to ensure that they're in line with the current repo rate. When we look a little bit beyond the curve at the 10, 15 and 30 year, your 30-year yields have actually compressed, meaning you've seen some mark-to-market gains in that side because bond prices have gone up while yields have come down. But if we look at the mid segment, that is your 10-year and your 15-year, this is where the data actually stands out. So if we look at how the 10-year has moved this month, it started out at 6.3% and it ended at 6.38%. So there's been a widening of 8 bips. This creates an interesting re-entry point. Similarly, on the 15-year side, you started at 6.64% and you've ended at 6.69%. So while these don't seem like big moves in the market, in fixed income, every basis point, which is 100th of a percentage, makes a big difference in how your returns are going to play out. So this could be an interesting time for an investor to start looking at safer investments in terms of government securities, but at attractive valuations. Now that we've deciphered the yield curve, let's also look at the interest rate outlook. Now, the RBI monetary policy is scheduled to drop tomorrow, and if you'd like to know our thoughts on that, then subscribe to the channel so that you get these updates first. But digging in, I think it's pretty clear that the last policy in June indicated that the RBI did a preemptive rate cut, but they also changed the stance to neutral. This left a lot of room for worry in investors' minds, because the idea was that when you're in a neutral stance, the RBI can even hike rates. And we are quite a bit away from a rate hike simply because Advanced economies haven't started cutting rates yet. We are quite a while away from a rate hike simply because the Fed hasn't started cutting rates yet. More importantly, India growth is slowing down and inflation numbers are also moving downwards. This creates more policy room for the RBI to be in line with global central banks as well as its own domestic problems. So this essentially creates an even stronger case for fixed income. If you would like to make a smart, safe investment decision, then message us on WhatsApp at 9500027285. You can use the link in the description to send your message across.